Very good evening, fellow members and friends. Okay. Voice enough, okay? Sound okay, huh? Good, good. So this evening we are share with you on this. What is a good time to start your retirement planning program? As usual, we will do the disclaimer. The information is for educational purpose only, and nothing presented should be construed to be a recommendation to buy or sell any specific security. The information, software, and techniques presented should only be used by investors who are aware of the risks inherent in trading. Singapore Microcompressor Society and its executive committee have no liability for any investment decision based on the use of the software or any trading strategies or any information provided in connection with this talk. Okay, let's go. So the menu for tonight is these 5 points. Review of your current and projected saving. That means your current position versus your desired position in the years to come. Then after that, you analyze already, then you look at it, how to achieve the target with your so-called current position. I mean, how to grow your egg nest using appropriate investments. And once you have set it up, then you will do some investment portfolio checkup versus what your current risk profile is. And I think item number 4 is one area that I think more or less is a good reminder for what we can do to improve our CPF saving. Final part is to remind us to always pay down your high interest debt, because you may save here, you may try to grow your money, but if you are paying up more, your cost of fund is more, or you are serving your so-called those high or big ticket item, maybe a car installment or installment for very sound system or installment for any of the big ticket item, then you have to be careful to have to manage your so-called debt accordingly. Finally, we look at the conclusion, right? Effectively, when we say we want to study our current and projected saving, we have to start with when you are current so-called your living standard or living pattern or your type of style of lifestyle, whether you need to travel once or twice a year, or whether you go to every time go to listen to concert, or you will have all your weekend, you will eat and dine at all those good hotel or good restaurant. These are some of the lifestyle that some of us may have. So when you are no longer in active, so-called economically active, that means you are no longer drawing a salary or making money in the market. So do you wish to continue in those lifestyle? That means finally when you hang up the boots, just like the footballer, when you hang up a boots, that means you no longer kick football around. So now you have more time. Do you want to have the same lifestyle or better, or even more better lifestyle than what you have enjoyed? So having understood what type of lifestyle you wish to enjoy, then you must ask yourself, have I saved, or what I need to save to make that dream a reality? Or some people may want to go to attend, example, some major sporting event like the World Cup or these Olympic Games. This could be a dream. In fact, this is one of my dreams. I almost go to Tokyo if not of the outbreak of this COVID-19. This was one of my dreams, to watch live the Olympic Games. You can also make use of your online retirement calculators. you can go online, check. There are a lot of CPF board and all those fund management company also got such thing as retirement calculator for you to calculate, check your retirement readiness score to see where you stand compared to other Singaporeans. Like normally they will ask you to input all those things like how much cash you have in the bank, including your fixed deposit and saving account, all these fixed it, and also how much you have lent to people that you or lend to the government or lend to whoever which you are getting interest and hope to grow the money and all this, right? From there you will compile your this is your so-called your asset lah. And then later you will compile your expenses. So you will review your current and projected saving. If there are gaps between your anticipated retirement income and the amount you need, then you have to make some adjustment to your lifestyle or your desired lifestyle. So some suggestion by some robot advisor is to start saving at least 20% of your income and trim your expenses at the same time. The goal of a financially secure future must outweigh the satisfaction of spending today well. What we are trying to encourage is you put aside some of your money, can be 10%, 20%, or 25% of your income, so that you spend less, or you cut out the cake already 1/4 or 1/5, put aside into your saving fund. So effectively, you will spend less. Instead of having 2 travel trips per year, you may have 1 only, and then you budget it such that there's a maximum amount you set aside for that trip. So you may not travel so far, or you may not travel so long, right? These are some ideas that you can look at. Having decided how much you plan to save and how much you plan to cut on your expenses, we have to remind ourselves also that in a country like Singapore or the city-state of Singapore, because of our good so-called medical facilities and medical so-called this type of treatment we get. So we, according to those insurance experts, the actuary, actuary or what, they forecasted that every Singaporean should live up to about 65 years or longer. Normally, if they say on average 65, that means if you are a lady or a woman, you're expected to live another 5 years more. So if you want a comfortable retirement, you need to invest more of your saving. It means it's a question of time. If you live longer, that means the number of days or number of months have to be increased accordingly. That means if you budget every month, your expenditure is $2,000. So if you live another 5 years or 10 years, you have to times 12, times 2, right? Accordingly. That's because you risk losing money in real term if you keep too much as cash. Now, this concept of the purchasing power parity in economics term is that last time I recall I eat a bowl of kok mee, maybe about 10 cents when I go to school, right? Now you go to food wet market, or you go to HDB market, or go to the coffee shop. Now easily you have to pay about $3 for basic one, or maybe $4 with some extra liao. So you can imagine the inflation that we have built into our economic system over the years. Effectively, that means there's $1 you have now, if you do a projection down the line after 5 years or 10 years or 15 years, then the buying power of that $1 will not be able to buy so many things $1. Then the purchasing power may become much lesser, maybe it will become 1/3 or 1/4. That means you won't able to buy so many things with that same $1. So the main reason is they call inflation, right? So Singapore yearly inflation rate has been historically, it have been said that it's around 2%. So if the so-called the saving account or your fixed deposit account or whatever account you're using to help you to grow your money is not able to pay you the type of so-called interest rate or coupon rate in terms of bonds, then effectively your the amount of money over the years, even you don't spend, you were not able to buy so many things. You will be buying less, subject based on this concept of inflation of around 2% in case in Singapore. So that means, in other words, it is suggested that you have to somehow put the money to work, whether in the whatever account, investment account or some sort of a bonds account or some sort of account that help you to generate a projected interest rate of 2% or more. So at least that will help you to call. Is one suggestion. Now, as most of you are familiar with, every time you look at the fixed deposit interest rate advertised by the banks, now because of this COVID-19 case, in fact, before COVID-19, the US so-called Fed, FED, Federal Reserve Board, we set the what I call the interest rate for the government. That means if the bank want to borrow from the government, how much they have to pay. So they set it from 2-3%, 5%, 2%. Now is between 0 to 2.5%. Or sorry, 0 to 0.25%. So you can imagine if the bank borrows so low, how they no need to so-called, there is so much money they have in the account, they do not need to pay so much interest rate to attract your money. They can easily get so-called fund in the market at much lower rate. So effectively, most financial institutions will not so-called be so foolish as to pay you so higher interest rate, because they can easily tap the money market at a much lower interest rate. So next thing is to grow your assets fund using risk appropriate instrument. Any surplus theoretically should be invested. That means we should not allow your spare money sitting idle in your bank account, right? Next, about growing your assets fund using risk appropriate investment. Now, as you always understand that any investment attract risk. So only when you so-called the central bank or the MAS, they issue, or the government, they issue bond. Those bonds normally they pay you 0.5 or what percent interest. Those are considered called risk-free interest. So major banks and insurance companies, all these things, normally they will subscribe or buy this type of risk-free or very low risk instrument, which in turn they will use it to lend out to their depositor, to their customers, at maybe they charge you about 1% or 0.8 or what. So let's say you want to buy a house, okay, they pass you 1.5% interest rate or something like that. So where they get the money? They get the money by buying the bonds or the government security at very low interest rate. So they lend it to you at 1 point something. So effectively they make 1% interest for the NI net interest income, NII. But of course the banks, they cannot, they borrow $1 from the government or the MAS or this or the central bank. Under the banking rule, they are not allowed to lend out more than, I mean, $1 to $1. They normally have to keep a reserve ratio. The reserve ratio is set up or controlled by the central bank. They will say, okay, every $1 you have to put 20 cents in the reserve fund. You only can lend out 80 cents. Like, so that is what I call the guideline. So they don't allow them to borrow $1 and then lend out $1, not allowed. And at this point, I just share with you why, the Ant, that means Alibaba, Jack Ma's, this IPO of launching of the Ant's IPO in Hong Kong and China was halted just few days before the official launch. The reason being, the thing is that the what I call the digital fund market, like Ant or this thing, they have what I call, they are not controlled by the Banking Act, whereby if you are the bank's license so-called is issued to them under certain Banking Act. So by and large, all financial institutions, whether it's like in Singapore or China or wherever, they have the guideline that every $1 they get from the depositor, they only can lend out 80 cents. So to keep the reserve ratio of 20 cents or maybe 15 cents in the bank, which they cannot touch and use it to lend out. Whereas Ant Financial, being a digital bank, they are not so-called governed by this act. So as a result, they can borrow $1 and can lend out $1. So effectively, they have a so-called advantage over the conventional bank operation. So they will make more money and they can be very tricky with the interest rate and all those things. So they will attract more customers. So because of that, it is something like not fair for the banks people who has to do so many things, hire so many people to comply with all the rules and regulation, and yet are unable to maximize their loan portfolio. So because of this so-called difference of guideline or the Banking Act, so all these so-called internet company, they have not been bounded by all these Banking Act, but they try to operate as a bank. So as a result, they have been able to make a lot of money. So right now, all these central bankers, whether Singapore, China, or whatever, they are waking up to it. So they are trying to introduce certain guidelines to manage or control all these internet banking companies or internet companies or those startup companies that get involved in doing financing or some sort of lending of money. So now you can see Grab also try to do some sort of financing. So a lot of these startup company, they all have been trying to bite into this area of the business that is traditionally reserved for the bank, and yet they are not controlled by any act that whereby they have to comply to certain things. Like, so Next, we come back to here again. Investing now more doesn't mean investing into a mixed bag of assets. This trying to explain to you is about when you invest more, you cannot say I just okay when this any opportunity to invest, you look at it, hey, can do. Whether the insurance company guy come to ask you, hey, you buy this single premium insurance, you pay for 4-5 years, either one time or spread over 5 years, then you can take back your money after 5 years with a so-called average interest rate of work out to be 2% or 3%, and then at the same time you will be covered for a certain protection of 1:1. Maybe if your premium is 10,000, you will have a 10,000 insurance coverage at the same time. So this type of so-called protection and investment type of product, so the investment linked protection product offered by the insurance company is very popular among Singaporeans also. So this is one of the so-called investment tool that you can consider. Then there are some they buy into certain so-called structured product. This structured product maybe say consists of some equity, some indices, and some fixed income. So they say, oh, you buy this product, the return is better than just buy a fixed income product of those bonds or what, so you can get better return than the fixed deposit, you know. So in the market, there are quite a lot of way they package the product for you. So if you are not familiar with this type of packaging, so you do not really fully appreciate actually what is this product? Is it a insurance product or is it a investment product? Investment product is basically is that you invest in something, it will help you to grow your money at a certain projected interest environment. Over the longer term, you can double or make return of more than how many percent. Right? So that is the concept of investment. And also, some people go into this LoJack method of investment without understanding the theory of diversification. Diversification effectively means you, example, a well-diversified product portfolio consists of a good mix of equity, that means stocks and shares, bonds, that means whether it's a government bond or corporate bond, real estate. If you're not in the big game, you only can buy real estate investment trust, the REIT, and other type of asset. So this should have exposure to different sectors and geography. So the concept of diversification is that you don't put all your eggs into one basket or one type of product. You try to invest in the different type of product whereby they are not so correlated. That means if example now in the COVID-19 case, if they affect certain kind of businesses, so if you diversify, that means you are affected by this, but because you invest in certain shares or certain bond that are what I call health care related one. Like example, lately those are top growth, you know, those or those what called the UE health or what, all those sector that is related to COVID-19, making those healthcare related product, they are having a good time and making a lot of money. So that means you even involved in equities class, you should try to diversify into healthcare, property, financial, electronic, or something like that. You know, so you should not have all in one side of sector. You have to diversify into different sector. And then for those of us who are more knowledgeable or understand the world market or regional market, then you can consider to participate in equity or bond or real estate trust in that have exposure in outside Singapore. I mean, when we say different geographical, that means it's not within Singapore itself only. So some of the product, they got exposure to Australia, or some have exposure to Hong Kong or China and all these things. So hopefully, when example, Singapore right now not doing well, but they say China is, the industries are generally doing well, they are still growing. So if you buy into a REIT or buy into a stock that is primarily doing business in China, so you will have so-called positive return from that particular investment, even those that is compared to your strictly 100% invested only in Singapore, within Singapore boundary. Of course, when you go into geographical diversification, you have to also prepare for what I call the country risk as well as the currency risk. I'm not sure whether can you remember. Example, now the exchange rate between Singapore dollar versus Malaysian ringgit, you can see about 1:3. So example, you have invested in a property, let's say in Johor, you buy a certain, let's say $500,000 Singapore dollar value of a landed terrace house or shop house. Now, you are projected to make 18% or 12% or 15% in terms of ringgit from that investment. And then it's projected the rental income, you can fetch so much, and then the so-called the appreciation of the property is how many percent over a longer term time frame and all this. So assuming that this is well and good and is living up to that image, growing so much, but then because let's say during the time one Singapore dollar and when one ringgit is on par, but over the years, let's say your investment for that property is supposed to be 20 years. So now of course Singapore is 50 years old already. So maybe you enter the market when Singapore was 25 years old. Now another 25 years later, supposedly the property should grow and then your return from that property should be more. But because of the currency risk and political risk, so even the ringgit value of the property has grown by, let's say, 50%. But the dollar value, when you convert back, the ringgit value, when you convert back to Singapore dollar, is become 1/3 of your original one. So effectively, you already depreciate your money has been become smaller already, 1/3 of the original amount, right? So and because all these things, even the investment gain cannot offset the currency depreciation. So while important for any age to having the right asset allocation for investment portfolio become ever more critical in this decade of your life. Two things will help you to decide: your risk tolerance and your timeline. That means how long you are prepared to hold that investment. The traditional concept of investment is over time. Let's say using the 7% rule. They always say that over 10 years, your $1 will become $2 at the interest rate of 7%. Normally, after 7 years, your investment should double. That is a conventional thinking, the so-called the rule of compounding. But if your asset class, for some reason, like the ringgit versus Singapore or what other particular currency exposure becomes smaller, then all the so-called theory of compounding over the longer time frame may not happen, right? Then the next question is risk tolerance. Risk tolerance is, that means how much you can stomach the value of your portfolio going up and down in the market. Because just like some of us, take for example, Singapore share market, look at Singtel, Singapore Telecom. In 1980 something, the time when they first launched Singtel, it was launched at $192. So over the years, they go up to $3, $4. So assuming that you bought in at the initial phase, then along the way, maybe $2.80 or $3 already sell off, okay. Then later you like the counter, you go and buy back at 3 something. So went up to $4, but you didn't sell. You said can go out some more. So now you reverse, 250. Recently you say, hey, cheap, now buy some more. Then drop to now almost $2. So looking at this concept of timeline and the risk tolerance, so you begin to question yourself, hey, should I continue to take this risk for this declining stock? No doubt it's a blue chip company and very well managed company. But due to market forces and due to political so-called factor, the share price has been coming down and coming down. So that's why we have to decide the type of how much risk you are prepared to take, and whether, if example you buy something at $1 cost, should the thing drop to 80 cents or around there, that means the value, your capital has depreciated by 20% over maybe a few years, 5 years or 8 years. Should you cut loss? That means sell out the thing at a loss of how many percent you prepare to cut that loss? You don't want to you don't want to continue to look at it going down some more, because you have a cut loss program to handle this, right? So instead of growing your money, now you prevent your money from depreciating more, right? Give your investment portfolio a detailed checkup. As we grow older, it's likely that your appetite and need for investment risk may change. So sometimes it's suggested we have to do that's your body annual checkup. So you may want to do an annual checkup of your investment portfolio. Take out your spreadsheet, look at what you bought and what price you buy and what is the current price it is showing, and looking at the whole economic environment or the indices, whether your portfolio is doing well or not doing well, and whether it has already come to your your risk profile, whereby you have to take some decision whether to cut loss or continue to hold that portfolio. So managing risk, especially drawdown risk. Now, drawdown risk is a very simple way. Take for example, you buy something at $1. When you draw down, that means the thing drop. Let's say drop to 70 cents. That means 30% drawdown. So are you able to handle this drawdown according to your plan, program, the lifestyle you have, and all these things? Do you want to handle or want to continue this drawdown? Because if you take this drawdown, that means you cut loss. That means you already know that instead of growing your money by how many percent over how many years, now your money depreciate or become smaller by 30%, right? So your portfolio may experience temporary losses. Hopefully that loss is a temporary one, but what you don't want is a catastrophic loss. Catastrophic loss is, that means almost like a sinking ship. I mean, you never see, as the famous saying, when I will see you again. That means you will never see that particular equity or the particular stock or particular investment anymore. Totally like gone with the wind. So this is a called catastrophic loss from which you never recover from. And remember, the mathematical formula is that, let's say you buy something at $1, say a 50% loss, that means you drop to 50 cents. So now your portfolio is worth only 50% of the initial outlay. Now, in order to give that 50 cent can double up or grow up by 100% over the certain period, effectively, you just come back to $1. So that means you didn't suffer from that 50 cent or 50% loss, but you also didn't make anything. You just go back to square one when you first started. So that means if your investment loss is 50%, you need to recover 100% before you come back to break even, before you're talking to make money. So you can imagine how difficult it is. If you didn't manage your loss at a proper point, you want to just recover back your capital, it will take you also many, many years and many so-called cycle of the market chain. Then maybe you have a chance to recover again. Right. Okay, next is give your investment portfolio a detailed checkup. Now, some of you may be familiar with these names, SYFE, SYFE. Now, in Singapore, this SYFE just came into the market about 2019 last year, November or October. It is what I call a robot investor. What basically is a robot investor, which is basically a computer generated investment advisor. That means once you sign up account with this site, you have to key in all your personal data, how much cash you have, how much you have CPF, and what is your risk profile. I mean, how much loss you are prepared to take, and what is your age, and when you plan to retire, and then what type of geographical diversification you are prepared to do. I mean, when you want to buy bonds or stock or what, besides Singapore, you want to buy also from China, from USA, from Australia, or from London. I mean, they call geographical diversification. So all these parameter you will key into the system, and then the computer or the robot advisor will churn up a so-called a recommendation based on what you have and how much you prepare to invest. These are the way you should park your money. How many percent into portfolio A, how many percent portfolio B, how many percent portfolio C, like that. So based on that, that's why this Strive Global Portfolio is designed to shield you from significant losses when market crash or be at the front foot when the market recover. So in times of significant mortality, Strive automated risk managed investment strategy, they call ARI, automated risk managed investment strategy, reduces investors' exposure to equity while increasing the allocation to bond. These Strive effectively they invest in exchange traded fund. I mean, their portfolios are they buy into many exchange traded fund in US, in Europe, or all the countries. So their portfolio constructed many exchange traded fund. So the exchange traded fund, the underlying for that fund can be an equity, or underlying can be a bond. So it's a mixture of different type of product. So this robot advisor will automatically balance your portfolio based on what you have tell them in terms of your risk profile, this thing, right? When misaligned, give your investment portfolio a data. When misaligned, the tendency is for investors to panic when they see their portfolio in the red. That fear can drive investors to permanently exit their investment and flock to cash. Now, during this COVID-19, I think sometime in March 20 something this year, market worldwide crash, Singapore also crash. Okay, crash normally when you say is sudden drop of more the drop more than 20%, then we call that market crash. So during that crash, some people may have liquidated their portfolio. That means they get up their investment and take out their cash. That means they withdraw their investment and go to cash. So according to this so-called investment robot, they say this is one of the worst money traps to fall into in your 50. So now we are talking about preparing for retirement. That means if you have invested in something and when you hit 50 years old and you have already a portfolio of certain things that you invested, during this so-called panic, what have you done? If you have liquidated it and get cash, you may have going to miss out subsequent rally, but potentially losing out on another 10 to 15 years of solid return in the market. Where's a simple example? During that market crash, if you have done nothing, that means you're still holding to that portfolio, the thing rebounded within the next 2-3 months back to or before the crash. And in fact, sometimes it grow higher up, which happens in Singapore. So effectively, you are steady and you didn't do anything to cut loss during that period. You are better off after this sudden crash and rebound. So, but of course, during that period, I would say after the thing happened, of course, a lot of experts can tell you this and that. But during that period, have you consulted or if you are invested in certain portfolio or in certain fund, you call the RM or relation manager or your so-called insurance agent or stock agent, or ask them what should you be doing or what you advise me to do. And if you take note of that advice given to you and then subsequently you follow the advice and then you did not suffer so much loss or you suffer very little loss, then you can say that that is a good investment advice that you receive, right? So, but if you didn't get any advice, but you also don't know what to do, you just sit tight and hope for the best, and then now it's the best come up, then it means luck happen to work in your favor, and but don't forget your initial investment in certain portfolio, you would have done some homework whereby you may have already done some diversification. So if you didn't park everything in one basket, then you also will be able to get out from this sudden so-called panic situation with not that much damage here. So this robot advisor Strive Global Portfolio will not keep a conservative allocation permanently. The average equities allocation is 60% for moderate risk portfolio. So you have input your risk profile that you are a moderate risk portfolio. So when volatility starts to subside, the share of your equities in the bond will increase again to benefit from recovery. Now, most of these what I call at the moment the robot advisors are invested in this type of ETF funds or this thing, for the simple reason is that the ETF is itself is also a diversified portfolio. So, and if your particular ETF consists of many equity or many bond, then you again have a certain diversification. So, basic the robot advisor will pick for you or looking for you that when the thing is very uncertain, sometimes they will move your funds or your investment in their portfolio to more bonds and less equity. Then also when the environment is much better, then they will move some of the fund back to have more equity for a moderate portfolio and less bond. Because you put a lot of things into bond, the return will not be able to give you so high return or so good return. Because as you know, bonds normally the returns are very stable and very predictable in the region of 100%, 0 point, depending whether it's a government bond or corporate bond or this thing. So will be much lesser compared to equity. Now, this is the part I think you all may like to pay attention to. Another milestone to look forward to as you pass the age of 50 is related to CPF. At the age of 55, a CPF retirement account will be created for you, and you can withdraw your saving from your special and ordinary account after setting aside your retirement sum. Now, this retirement sum is you have to check what is your age, and then at each year you retire, the amount has been building up over the years. So, take for example, at my age, my retirement special account, I have to put in 60,000 example. So, the 60,000 can consist of strictly deduct from my special, my ordinary account, and then anything over and above the 60,000 sitting will be transferred to my retirement account, and whether I will able to withdraw from this special account or this retirement account. So if you don't need the money now, consider withdrawing your CPF saving at a later date. That's because your CPF saving can earn up to 6% interest per year after you turn 55 years. This outstrips the interest rate for saving account and even FD, fixed deposit, with the banks. Moreover, your risk is nearly zero. Now, when we do investment, we always ask what's the risk and reward. So normally those product or the investment that you put in, let's say you're able to get 2%, there should have an associated corresponding risk that you are prepared to lose, maybe 0.5% or 1% or this thing. Because risk and reward always there's a interlink. But if you leave your money in the CPF account, and potentially you can, if you are not withdrawing that money, you potentially can earn up to 6% interest per year after you turn 55. So this will be much better than any other bank or fixed deposit. And also the risk is almost zero, unless Singapore government pingsan, used alongside with other instruments, you are essentially diversifying your risk exposure even further. I don't know about why there are a lot of self-employed people or low-income people and all these things who don't have much CPF saving have been complaining to the MP, to the government, or to the CPF board that how come this is my saving? How come I'm not allowed to draw down at the age of 55 like before? I have to maintain a minimum sum. I cannot draw, I have to set aside the minimum sum and all these things. Even some of them may be aware or may not be aware that actually you can attract higher interest in your CPF account. Of course, the circumstances for each account holder of the CPF different. Like many of the self-employed or those hard-working lower income group, they really work hand to mouth, and sometimes their bosses have been not been fair to them, did not really contribute the full CPF, or they did not cross. CPF, if you are wage earner, supposedly you pay a certain percent, the employer also have to pay a certain percent to make up your total CPF contribution to your account. But over the year, there have been a lot of so-called unfavorable practices by some of the bosses, whereby they don't participate in their portion of the contribution to your CPF. Then you have to pay almost 100%, both the employee and employer portion, in order to grow your CPF account. So this is the unfortunate thing. But over this year, slowly, as people are more educated and they complain to the CPF board, so you find that many employers nowadays are being brought to task for misusing this or manipulating this so-called this sort of CPF contribution to save on their own pocket. Next point is that if your spouse is a homemaker, chances are that they may not have accumulated much CPF saving. To help boost their CPF monthly payout, consider making a top-up to their retirement account using CPF or cash money. The good thing about using cash is the personal tax relief. You can get up to $7,000. And if you will enjoy one more tax saving, top up your own CPF account too. You can also receive up to $7,000 in tax relief while earning more interest compared to leaving your cash in the bank. So go and look through the CPF board about this top-up scheme to your retirement account. Right. Finally, reducing your debt at this stage of life is important. Once you retire, the interest payment on outstanding loan can eat into your retirement income. This is common sense. This can create unnecessary stress and worse, make it more difficult for you to service your debt. That explains why, let's say you want to buy a maybe HDB flat or buy a private house or buy some property, whether shop house or office space, or there's a guideline that the bank will practice. They will look at how much is your income in order for you to service the loan, and then how much, if it's a property, how much you can draw on your CPF income, CPF saving, and then what is the actual percentage in terms of your loan that you are requesting, and then how many years you are lending the amount, and then based on that they work out the capital they are prepared to lend to you, and then what the interest rate they will charge you, all these things, right? So for those who are no longer working, or you don't have a regular, or you didn't declare your income to the income tax accordingly, so sometimes it's a bit tough for you to able to get a loan from the bank or finance company. Of course, it's very good that if you have a lot of cash, then you don't need to borrow at all, and then you can use hard cash to pay for all your investment. Whether you buy a big ticket item like a nice motorbike or a car or some other, maybe a jet plane or whatever, then you're okay. But if you don't have enough saving and you are not having, your money is not working for you to grow it, then you still have to service your debt, whether your housing loan, your car loan, or whatever loan, or maybe worst case, you're serving the maybe educational loan of your children, then this can be a big headache for you. But once you stop working or you no longer able to bring money home, then how to go to service the debt? And if you don't have a saving to pay off the debt, then you still continue to pay the interest plus the principal for the loan, then this can be very challenging. So conclusion, set the foundation for your golden years today. So in this decade of your life, a comprehensive financial checkup is as important as a physical health examination. Understanding how much you have and how much you need to achieve the future you want is the first step to financial security in your golden years. Many find that speaking with a trusted wealth advisor can help. Right? That means you can talk to your financial planner to do a financial planning proposal for you. So that's one way. Now, many banks, they also have, like example, DBS Bank or POSB Bank. You go into the website, they also have a DIY, means you can do yourself of financial planning. You can key in all those data they ask you to do, key in everything. Then theoretically, they will tell you how much you need to have now and how much you have to grow your saving to achieve that target you want. So then you look at your saving yourself and look at the type of passive income that you're going to achieve, get, whether you're able to fulfill your dream. So reality check helps to shield you from any economic headwind ahead. You don't have to make drastic changes immediately. So it's okay to make small steps toward this goal, like increasing your monthly investment contribution by, let's say, $500, or committing to invest any bonuses you receive. Right? Your 50 years old may be a busy period, but taking the time to carefully assess your financial situation and investment will bring you closer to retirement you are dreaming of. Right? So yeah, I've come to the end of the presentation to invite you to discuss or bring up any question that you may have.
8点就是我们全部走了。
那你们走了，那8点就是已经有陆陆续续。
7 plus most people together.